Let's talk more about stocks, which continue to deteriorate this afternoon as the risks facing the markets pile up. Margaret Vitrano is here. She's portfolio manager with ClearBridge's Investments. It's great to have you on set. Welcome.
Thank you.
You know, it's interesting because you're in an area that's been so strong growth primarily. You know, even so, you've been a little bit underweight tech and so forth. Are they going to be able to withstand this rate shock better than other areas? Or, I mean, I see now you're looking at healthcare maybe. So just talk to us about how you're kind of thinking through these.
Yeah, I mean, look, I think many of the large tech companies, one of the reasons they've acted both offensive and defensive over the last couple of years is because they have great balance sheets. So if we do have a sell-off, you know, should some of those mega cap tech companies hold up well? Sure, because they have really great balance sheets and that gives them a lot of ballast. But when we think about, if you had asked me 2 or 3 years ago where we're spending our time, I would have said internet and tech. Now, not as much. I mean, we think that there are some other areas of the economy, healthcare, beaten down healthcare, where you can really find some good value and have some defense in your portfolio, or early cyclicals, where we may be a little bit early, but coming out the other side of the slowdown, I think there's a lot of opportunity to perform there. So diversification, I think, is really key right now.
Yeah. How much do those rising rates, I mean, we showed the chart of the rising rates on the 30-year side of things, the 10-year side of things. There have been fundamental drivers with obvious reasons for the data coming out. Does that put more of an onus on you as a portfolio manager to scrutinize balance sheets on the leverage side of things, to look at whether or not certain companies who use a lot of debt to finance their operations may be at risk in the coming months, quarters, or years, depending on when their maturities happen and when they have to roll that debt into higher interest rate debt?
I tell you, it's certainly more of a mid-cap, small-cap problem because most large-cap companies in the U.S. have overcapitalized balance sheets. Where you're going to see it in large-cap land is earnings compression from higher interest expense. Certainly, they're going to have to roll over some of their debt at higher rates, and we're going to see that in less earnings growth. I can see that happening, but not to the point of financial distress on the large-cap side.
Yeah, again, you think maybe these are the ports in the storm. So when is the effect of higher rates really going to bite? You know, for a lot of companies, it feels like, okay, maybe they termed out some debt in recent years. As you're looking through and trying to figure out, okay, what's safe and what's not safe, are you literally getting balance sheet specific?
We are, just to make sure that they are overcapitalized, to make sure that nobody, of course, has any financial distress risk. In our technology and internet portfolio holdings, we don't have companies that aren't profitable. So that's where you're really going to have a problem. Any company that's not profitable, that maybe was a popular stock in 2020, this is a problem when you have much more capital constraint.
And what about the pipeline? I mean, in the last several years, tech, the IPO market, I mean, this really delivered kind of this whole new crop into the market, not up to large cap levels yet, but all of a sudden that's dried up now. All of a sudden, that early stage kind of growth part of the market, the small cap growth, if you want to call that, looks like one of the weakest. And what are the ramifications of that?
Well, the ramifications are that when we talk to our portfolio companies, for the first time in several years, they're excited about the opportunity to do M&A, right? So if you had asked them 2 years ago, they would have said, we can't afford to buy any of these companies because they can go public and make a higher price than we can ever pay for them. And now that's coming back to them.
That's a great point.
I mean, let's put rubber meets the road on this. Portfolio manager, stock picker, you got to put client money to work.
Yeah.
What's on the shopping list? You made some allusions to things like early cyclicals, to healthcare. What types of stocks are we looking at that go on your shopping list?
Well, first, you know, we do want to make sure the portfolio has some defense. You know, we are facing a more challenging period over the next couple of months, couple of quarters. And so beaten down healthcare, I think, is really interesting. It gives you good value and some defense. We like Thermo Fisher Scientific. It's a really good quality company, good compounder, very diversified. And interestingly, the issues that are affecting them right now, slowdown in China or COVID destocking, those are not long-term problems. This is a very good company long-term, and we think they can get back there. Early cyclical companies, I think, is where you want to look next because we will get through this.
But
it's so tough right now to go that route.
Inch your way in, because there are companies like the railroads. I mean, I never thought I'd be a growth manager talking to you about railroads, but this is a business where they still ship things like grains and lumber, which have some defense. Self-help. This is a self-help story.
But what is it? Is it Norfolk Southern? Is it Union Pacific?
We like Union Pacific. They have a new leader. The company has not done a very good job of execution over the last couple of years. And I think this new CEO can help improve on-time performance, can help improve safety. That drives volume. That drives profitability. So we're going for self-help. And hopefully that'll save us if we're early.